Thanks everybody for coming. Sorry I was a little bit late. Trying to get all this technology hooked up. So what I'm going to try to do today, we've got a live version, which you guys came down, and then we have some online people. So I'm going to have my headset on, and hopefully everybody's on the same page, so we can go through the slides. But if you guys have any questions, just shout them out. This is very informal. Okay?
You have to shout loud because you got your headset on?
Yeah, shout loud.
Yeah, or maybe put up your hand.
Or just
So, yeah, and I can't hear, so. Okay, hello everybody. We're going to get started here. We have a good group live, so I'm going to turn my video off so you can focus on the slides. And again, if you have any questions, just feel free to type them in the question and answer, and we'll get started. Thanks, everybody. Appreciate you guys jumping on here on a Saturday morning. Okay, so today I want to talk about credit spreads and some things that I've done on credit spreads that have helped improve my results a bit. And so we'll just go through the slides. So today, can you all see that?
Yeah.
The agenda. What I wanted to do is, definitely talk about defining credit spreads, talk about the risk and rewards, some additional trading rules that I built into my strategy, some early results of that, and then definitely want to answer any questions anybody has. So that's that. And so let's get started with the definition. So this is going to start off pretty basic just because we have all different levels here. So a credit spread is when it's an income generating strategy. And what you are doing is you're selling one strike, a put or a call in one strike, and then buying another one. So in this particular example, I did this as of this morning. So Meta, if we wanted to make a trade in Meta and we were bullish, we could buy, the stock is trading at $325. We could sell the September 300 put and collect $5.25 or $525, and then sell the $295. So, and you would pay $4.20 for that particular. So you would get a net credit of $105 per contract. And so in this particular case, your max reward is $105. We can't make any more than that no matter what happens to the stock. And the most you can lose is $395. So that is the, that. And this is what it looks like on the option chain. So it's just, you sell one option and you're buying another. So that is all. And on Tastyworks, it will give you a probability of profit at 50%, which I use as a guide just to, is this a good, pretty good high probability trade? So one of the first things that a lot of people ask is when you risk $4 to make $1, a lot of people will say, that's a terrible trade. It's just a terrible idea. And, a lot of people will say it's equivalent to collecting pennies in front of a steamroller. Y'all have heard that expression. So, but there's more to the story than that. So let me just get to the next slide here. And so in this particular case, we've risked $395. That's the max risk. If we just ignored this trade, walked away, and 45 days later, the most we could lose on the trade is $395. The most we make is $105. So, but what that doesn't take into consideration is probability. So in this particular trade, we have a 85% probability of profit at 50%. So, if you think about it, it's kind of like if you go to a casino or run a casino, people make small bets, right, with big risk, big rewards, right? You buy the lottery ticket, you pay $2, and you could win 100 million. If we're the lottery company, we're the casino, we collect enough small premiums along the way, and we mitigate that risk. So that's kind of the idea why this strategy still makes sense, even though the risk-reward ratio doesn't look too appealing on the surface. So, any questions so far?
Where'd the 85% come from, Ryan?
I just use the Tastyworks number.
They tell you?
They tell you P50. They give you a P50 on every trade.
And Thinkorswim does too, doesn't it, Ben?
No.
It doesn't call it a pop, but doesn't it give you a maximum loss?
Not really. It gives you a maximum loss, but it doesn't give you a percentage of the profit at 50%.
So you'd have to manually
Do the math.
calculate, So
Yeah.
you're an engineer, so
I'm not good at math.
let the bride do it.
One of the things that you can keep in mind, if you're selling a 25 delta strike, then on odds, that strike has a 25% probability of ending up in the money. So, or 75% of it not ending up in the money. So, and because you're you have a better, you're not going to stick around to the end, you're trying to get profit at 50%, that's why it's a little higher than the delta number. But if you didn't have anything and you said, I'm trading a 25 delta, on surface, you have a 75% probability of that trade working for you. So, and again, this would be a put spread, so it'd be a bullish trade. If you were bearish on Meta, you could sell a call spread. So it's the same principle. You collect a credit. And I always tell people, it's kind of like you make this trade and somebody hands you $1 and you've got $4 at risk. And to get out of the trade, you have to either let it expire or give them something back. So if you collect $1 and you give them back 50 cents, then you've kept that 50 cents and you move on to the next trade. Does that make sense? A lot of people have a hard time kind of understanding when you sell credits, when you sell options, you're collecting money, you hold the risk. When you buy options, whoever sold it to has the risk.
So credit versus the debit.
Exactly.
So this is the same expiration but different strike prices?
That's right. Right. That's what makes it a credit spread. You use the same expiration, which that gives you your defined risk. So no matter how low the stock went, the most you could lose is that the width of the spread less the credit received. Okay. So let's talk about some of the advantages of, here's a chart of Meta. So it's a good looking chart. It jumped up after earnings. It gave back some of its gain. Thursday, Friday, it was off to the races. So
Is that a 1 day? Or I can't see.
that's a daily chart. Yeah, that was off of Finvid. So let's talk about some of the advantages. Can you even read that? Okay.
Is something there? Oh.
Well, I'll just read it off to you guys. And I'll send you all the slides. So the main advantages of selling a credit spread is it's a defined risk trade, meaning that you can't lose any more than the width of the spread. So your risk is really limited when you put the trade on. The other thing that is really good about credit spreads is the capital requirement is very low and it's very scalable. You could start with as low as $100 doing a credit spread, or you could do $100,000 doing credit spreads. It's very, you could do a $1 wide spread on the SPY, so it would cost you less than $100, or you could trade, 100 meta trades and collect, $10,000. So That's kind of the, what I think is a good part about the strategy. And then the other thing is, if you put this trade on and totally forgot about it, you couldn't lose more than that $4 per spread. So that's pretty appealing to most people.
Is that true? What if it falls? What if it expires in between the two strike prices? You have exposure.
Yeah,
there.
at expiration you could.
Okay.
But I'm just trying to stay pretty high level.
Sure.
But yeah, I mean, at expiration, there's always weird stuff that can happen. But assuming, the stock, you close out the trade at expiration, that's the most you can lose on the trade. Make sense, everybody? Okay. So disadvantages. It requires a high win rate to be successful. So you have to, I would probably say at a minimum to make money on the strategy, you have to probably have about a 2/3 to 80% win rate. You don't have to have 100% win rate, but you have to collect enough small credits to offset any of the losses. The second thing is, if you're selling a naked put, remember on that example on Meta, you would have collected $525. So in this particular, if you just sold it naked, so when you sell a spread, you actually give back, a bunch of that money for that defined risk trade. So some people like to sell naked puts just to collect that additional credit. And then the other thing is that because you're selling two options and you have to buy back two options, there's more commissions. So if you just sold one, you'd only have one commission to sell it and one to buy it back. So in today's day, option pricing is so low that it doesn't really matter, but that is a factor. And then the other thing is time in the trade. You're going to be in this trade anywhere from 1 day, which is really unusual, out to 30 days. So you're going to be in this trade for a period of time. Not a long time, but it's not a day trade. That makes sense? Okay. Okay, so one of the questions was a great question is, do you use the same expiration date? Yeah, someone in the group asked that. So great question there. And the meta chart, I'm not sure what happened, but it just was showing how bullish it was after earnings. Okay, so the risk is the defined risk, right? The $5 less the $1 you correct, that's $4. The other piece that, kind of Lee alluded to is assignment risk. So if you sold that put spread and Meta dropped $100 per share, you'd still only lose the $4. However, when you're selling that put, you do have assignment risks that somebody who owns that put could say, I want to, make you sell this stock short. So one of the reasons we sell options that are 45 days out is to eliminate or severely reduce that assignment risk. But it is a risk. I mean, when you sell an option, there's a risk that somebody could assign those shares to you. Their max reward, so on the, we've already covered this, you get $1, that's the most you're going to get per contract, $100. Now, a lot of people, myself included, don't want to stick around the whole 45 days. So I try to get out at a 50% profit or after a period of time. Like I just add, and I'll go over my rules in a minute, that I exit the trade after 21 days. I just find that if it hasn't moved in 21 days, I'll close it out and move and redeploy my capital. Does anybody else do something similar to that? Use a time stop?
Yeah, or 50%.
What was that?
Or 50%.
50%, right? Yeah, if you get 50% in a week, then that's great.
50% of what?
50% of the credit received. So remember the $1 you collected? If that credit drops to 50 cents, you can close the trade out, collect your 50, and then redeploy your capital. And that's one of the things that I'll talk about in a little bit, but how to kind of use the chart to manage your credit spread. Because a lot of people who do credit spreads, just put the trade on and they either leave it to 50% or when they're stopped out. So, and what I found is that if you look at the chart and come up with have a plan when it starts, you can grab your profits quicker and take less on your losses. So we'll talk about that in just a second okay. So next thing I want to talk about is expectancy. So, and you can't read that either. Sorry about that. So expectancy. It is clearly just if you take the average credit that you will get from the credit, calculate what your win rate is going to be. And I'll show you a calculation in just a second. And then you kind of figure out what is your net credit per trade. So that comes out to, on average, your trade will, this is a better example. Let me just skip that slide and just walk through the math with you guys. So if we have an 80% probability of making $50, which is the 50% of that dollar, then we will collect $42.50 per trade. And then if we lose, say we lose the whole $105 on the trade, which is 2 times the credit received, then that would, and we did that 15% of the time, we would lose $16 per trade. So the net expectancy of this trade at an 85% win rate would be $26.50 per trade. Did I lose everybody? Okay. So if you were calculating, you did 100 trades, and 85 of them you made $50, and 15 of them you lost $105. So if you added up all of the 50% winners, subtracted the losing trades, and then divided it by 100, that is the expectancy of the trade. So a lot of people will say, I'm not doing this trade unless it has a positive expectancy. Does that make sense? You just don't want to be putting on a trade that the odds are saying you're not going to make money on. Because over a period of time, the expectancy would hold place. Dennis?
Are you sending these slides out to everybody?
Yeah, I will. So at a 75% win rate, it would be $11.25 or 2.85% per trade. So if you made 2.85% per month on your credit spreads, that's pretty good, right? I mean, if you figure that's probably more like a 30-something% return annually. And that's at a 75% expectancy. So if you did on the 2650, if you did 20 trades, one contract, it would be $530 profit per contract. So if you did 10 contracts, you can just multiply that by 10 or whatever number, whatever size you're using. Okay, so there's a lot of different ways people trade credit spreads. I'll share how I do it. You probably would be either more aggressively or more conservative than my trades. But what I look for, I focus on the stock, not the option. So I do all my research on the underlying stock. So I don't want to, look at, what Apple credit is going to be unless I want to trade Apple. Or I can do it on an ETF. I'll say this ETF is in good shape, is in a strong sector. I want to trade it. So I'll make a list of all the stocks or ETFs that I'm interested in trading this particular week. I usually do it on a Sunday. So normally I take Saturday off. A lot of you guys know that I try not to do anything trade related. So then we scheduled this meeting for today, which is
It's your day off.
it's my day off. So I look for high enough IV. So anybody that's trading now knows what IV is pretty low, right? It's hard to find high IV. So I look for as good as you can get. So it used to be 30 IV, 30% IV was a minimum. Now, if you can get 25, that's pretty good for the trade. Lee.
Not in this room, but I see there's 31 people watching. What is IV?
Oh, I'm sorry, implied volatility. So the market makers, when they look at an option, they kind of build in what is the risk in that option. So if you're trading Meta, since we talked about Meta, if you're putting a trade on a Meta on Wednesday, the day before earnings, IV or risk is super high, right? So when IV is high, implied volatility, you get paid more to take the trade. You get rewarded for the risk. If you're trading Procter & Gamble, one of Bud's favorites, it has the lowest IV. It's like, a grandma stock. And so if you put the trade on, you can sell, and I don't mean to disparage any grandmas. It's just a super conservative trade. So if you sold a 25 delta put in Procter & Gamble, you wouldn't collect very much money in credit. Does that make sense? Now, the odds of Procter & Gamble dropping 10%, probably pretty low. The odds of, Tesla dropping 5% in a day, pretty regular, right? It goes up and down every day. So that's kind of why the market makers price in risk via implied volatility. Great question. Does that make sense, everybody? Okay. So, and on an option chain, you can look at what the implied volatility is. And if you look at it and it's 80%, something's going on with that stock. Either it has earnings or a merger or it's an FDA, approval kind of thing. So you just want to know what the IV is. So you want to make sure that for the risk you're going to take, you want to make sure that the option you're selling has great open liquidity, right? We don't want to sell anything that doesn't have at least 100 contracts in open interest. And I can tell you from experience that I have sold options that had low liquidity. Maybe I was the only one buying that option and the market maker selling to it. And they will pay you for the stock. They'll give you the option. The problem is nobody will buy it back from you. It doesn't matter. I had a case once where I made an incredible profit. And I said, I'm going to take my profit. I could not give it away. And that's the most frustrating thing in the world. So if you've ever been in that situation, you'll know to look at open interest. So, and everybody in this room probably has an example of a trade they made that they got great credit for and they couldn't get out of the trade. Does everybody agree with that?
Yeah, 100%.
So, profit goals. I generally shoot for 50% of the credit received. So if I get $1, I want to get out for 50 cents. That's pretty standard. But on the other hand, if you make 30% of the credit in the first week of the trade, I generally take my profits and redeploy my capital. So that's pretty standard. And then risking the trade, risk on the trade, they're pretty common. If you collect $1 and the credit grows to $2, then you probably want to get out of the trade. You don't want to let it get to $4, right? That's silly. So 2 times the credit is the standard kind of exit level for most credit spreads. Something that I do that we'll talk about is when I put the trade on, I look at the chart and I draw my get out line. So this, if I put the trade on and the stock's at 315, and I determine if the stock drops below 300, I'm exiting the trade. I don't wait for it to get to 2 times. That's something I've started to do over the last 3 months, and it's helped tremendously. So, and it doesn't take, you don't have to look at the trade every day, every hour. You can look at it, at the beginning of the day, midday, and at the end of the day. And so this is a nice, in our group, a lot of people talked about they wanted to have a strategy that they didn't have to sit in front of the screen and watch every 5-minute bar print out. So this is a great strategy that says, like if you have a longer term, a swing trade mentality, you could put this trade on, identify when you want to be notified via alerts, and then you can just go about your life. You don't have to sit in front of the computer all day long. So I know it's good for me because, if you're sitting in front of the computer all day long, sometimes it will drive you crazy, right? So this is a strategy that will help you be able to do other stuff besides, just watching the thing. So, a couple of questions is, if you have a lot of trades, and I'll show you a spreadsheet that I built. It's not very fancy, but I'll share it with you guys if you want it. And it helps me. I can look at any number of trades in about 5 minutes and know, do I have to do anything? So I'll show that to you in a minute. And when I look at the stop level, I'm really looking at what is a pretty strong support level. So if the stock is moving up and it starts to move down and it crosses below a really strong support level, that's when you probably say, you know what, this idea wasn't as great as I thought it was. So you might want to just exit the trade and redeploy your capital. You'll hear me say that a lot. Like you have an X number of dollars to trade, you don't want to have them tied up in stocks that either aren't moving or they move the wrong way. Does that make sense? Any questions here? Can you read that a little bit better?
Yeah.
You can turn the light off if it makes it better to see it. So again,
Right.
Hey, Leo.
Just quick question. So, on a $5 white trade, you mentioned $1 profit, $1 credit.
Right.
Does delta come into play at all when you're choosing the spreads?
Yeah, I generally, personally, like to sell somewhere between the 20 and the 28 delta, in that range. Because I want to win more than, I don't want to trade a 35 delta and only have a lower win rate. So, but a lot of people, I know people who say they just automatically sell the 30 delta. So it really just comes down, the more you sell, the higher the delta you sell, the more credit you collect, and the
risk goes up.
The risk goes up. So
So the delta on a spread is an average, or how would you know? For the credit and the debit.
The debit, on the credit spread, what you really want to focus on is the short strike.
Okay.
Because that's that's the one that's really at risk. Your long strike is really just to make it a defined risk trade.
That's good.
If
on the short.
Yeah. So if you sold the 25 delta and you wanted to do 10 wide, you're still collecting the same amount of credit for your short put, but you just pay less you have more risk, more reward. So, most of the time I try to sell a $5 wide just because it's so much easier to compare stuff quickly. Like for example, if you trade 5 contracts per trade, then I'm doing 5 every time. If you start trading 2.5 wide, 10 wide, that kind of thing, then your numbers of contracts is all jumbled up. And I have a harder time, calculating that than, so to me, it's easier. Just do 5 wide and you do 10 contracts per time, and that's how you calculate your numbers.
And that has the best open interest anyway.
That's true. Yeah. So, everybody's trading that 20 to 30 delta. So that's where you're going to find most of your open interest. So, okay. So the things that I do in terms of setting up these kind of trades, I focus on the stock, really not the options to start with. And if you trade credit spreads a lot, you'll know which stocks have good options. I mean, you'll know that if you're trading something you've never heard of before, odds are it doesn't have good options. So I always, kind of go through and I make a list of all of the stocks or ETFs that I want to trade that particular week. So I have create a watch list. And then I screen them through something like a website like Bar Chart or something like that to make sure that they have a strong bullish bias. So for example, if I want to trade a stock, came across my list and Bar Chart or any other rating services, it's a strong sell, I just move on to the next one. I don't find that, I don't need to challenge. There's enough good, strong charts that have good, high recommendations. And then when I start running the screen, I want to look at, what's the IV of those companies. Because if it's a 10% IV, I know that that's probably not going to pay me enough credit for my trade. And so I'll start with the higher IV and kind of make a list and kind of say, these are the stocks that kind of meet what I'm looking for. They're in a bullish pattern. They have got good enough IV, and they don't have earnings coming up in the next 30 days. So that's a big thing, is that, if you find a really good stock and it has earnings on, next week, you can't do the trade because you don't want to hold it through earnings. Okay, and then you also want to make sure that, is there any news on the company? Like Twitter, just, it's always in the news. Those are kind of things that can really move a stock price. I was just reading the other day, the European Union is investigating Meta and things like that. So you want to just make sure that there isn't any major news, like are they being acquired, or the CEO or the CFO just left the company, things like that. They're easy to find. You just go to Yahoo Finance, and it'll tell you if there's any news on the company. And then the next thing is you really want to kind of look at the chart, and if you're bullish, you want to identify a strong support level. And once you've had that support level, I always say that's your get out level. If it drops below that, get out of the trade. So, any questions about any of that?
And that support level is on the chart?
Yep, it'd be on the chart. So you would look at the chart and see at what level is the floor of that stock. So if it bounces around and it never drops below, say, $100, even though it's trading at 110, and your exit level would take you below 100, in my opinion, the way I trade is I get out of that trade if it closes below 100.
How are you defining a bullish chart?
If it's moving upwards at a nice 45-degree, 30-degree angle, from oldest to the newest, and it's moving, the chart is moving up. A lot of people will say it has to reach a higher high and a lower low, so you can look at that. But
over what time span are you?
I'm looking at a daily chart, and I want to look at a year. So
you want to see an uptrend for a year?
Well, it doesn't have to be a whole year, but I want to look and make sure it's not like up and down, kind of thing. You want to, another easy way to look at it is if you look at like the 20-day moving average, and you just drew a line on
Okay,
it.
that's what I was at.
Is that moving up or moving down?
Okay.
That's the easiest way to do it. Yes.
What if it's not a long-term bull trend, but a short-term, a long-term bear trend, but a short-term bull trend? Would you still be interested?
Depends. I mean, if it's a highly rated company that's in a bull, short-term bull trend, I might be. But if it's a weak company and it's sold off and now it's kind of rebounding, I don't generally go for those kind of trades. Just because there's other better trades to do.
You said you definitely don't want to hold it through earnings, but I assume that's because you're worried about the delta risk, but a lot of people want to hold it through earnings because they want the IV crush.
Yeah.
Can you compare and contrast the risk of holding through versus
Sure,
the benefit?
great question. So there are people, I call them like adrenaline junkies that love to trade earnings. They are I've traded earnings, so I'm bashing they are the funnest trades to make in the world. It's kind of like when you buy the lottery ticket and you get to see the numbers coming off, you win or lose. These are way better odds than that. So what happens is you can make your whole month's return in one day selling earnings trades. So, and the reason is because the IV, you're selling the IV at the ultimate peak of the, right before earnings. So you get the most credit for that trade. But what happens is after earnings, that stock is generally will tend to make a major move up or down. And in my experience, there's never a good correlation between good stock means it's going to go up. Bad stock is going to go down. I tried to do that, but to me, it's impossible. And so if you want to kind of compress the whole trade in one real short period of time, you can trade it through earnings.
Yeah, I had Snapchat that dropped 20% after earnings this week. I was in a put, so it worked out for me.
Yeah, I mean, they're great trades. They're fun to do, and a lot of people do them. This is not really about that, but so you can contrast. Like, okay, I want to trade earnings, like Snapchat. I want to buy puts because I think it's going to get crushed on earnings. But if it had gone up 20%, you're out of the game, right? And so it's kind of fun, right? But from my experience, there's never been and someone correct me if I'm wrong, but I can't look at a company and say they have earnings, they're definitely going to go up. I've looked at it. IBD has a section every week on the big earnings, and they will tell you these are the buy the put, buy the call. And I've tracked it, and they're about 50-50. And, the good companies have Microsoft is like a super rated company, and it got crushed on earnings. So Teladoc, probably one of the weakest stocks out there, blew up after earnings. It went through the roof. So I just think it's hard to trade it.
Does closing that right before the day before earnings, does that generally work out better?
No, because if you're selling credit, what you want is implied volatility to be lower than when you first got it.
Oh.
Because when implied volatility goes up, the credit goes up, right? So if you want to sell a credit, as it gets closer to earnings, that implied volatility goes up. So what we're trying to do is have IV decrease and the price move in our favor.
I don't want to go too far off topic or on a tangent here, but it seems to me that if you can predict direction with a 50% accuracy and you can predict implied volatility with 100% accuracy, then it should always make sense to hold through earnings.
I've never had luck trading stuff through earnings.
Okay.
But I mean,
Me neither.
there's a ton of people who do it. There's a couple of Facebook pages that are earnings only, and that's all they do. And I'm like, I love it. I mean, it's fun to watch. But I remember the first time I held a stock through earnings, and it was a small position, and I couldn't sleep that night. I was up all night looking at, okay, is the stock moved? Because it announced after the close. So all night I was getting up and looking to see how it moved. And I was like, I can't do this. I'm too old for that. So anyway, did that answer? As a roundabout way of answering your
Yes,
question.
thank you.
Okay, so the other, so you pick the stock, then you either have a bullish, bearish, or neutral thesis. And if you're bullish, you sell put spreads. If you're bearish, you sell call spreads. If you're neutral, you could sell an iron condor, which is just selling a put spread and a call spread at the same time. I have gotten to the point where all I'm selling on the credit spreads is put spreads. And there's a couple reasons that I do that. One is if the stock goes up, which is what I'm hoping for, IV will go down. And I make money that way. And I make money when the stock goes up in price. If I want to trade a bearish thesis, I usually do it a different way. And then you look at option liquidity, implied volatility, make sure they don't have earnings coming up. And then I generally sell the monthly option and try to go out about 45 days. So right now, I'm selling the September 15th options. At some point, I'll have to roll it to October. But monthly options generally have the best volume and liquidity. You can sell weeklies, but I generally just shoot for the monthlies. Okay.
Question.
Yes, sir.
You just said, I think if I heard you right, that you sell basically put spreads.
Uh-huh.
But when you're doing a zero DTE, don't you frequently do call spreads?
Yeah, different strategy.
Okay.
So these are my
General rules.
my credit spreads. I do trade zero DTEs and I'll trade calls and puts, but that's a different Brian.
That's a day trade.
This is the strategy that can consistently make money, and it can consistently make money and have a high probability of winning. And you don't have to lose sleep like I did over that one earnings trade. I get up every couple hours to see how it moved after the thing. Go ahead.
What percent of your portfolio do you trade in with this strategy?
This one, probably about 30% of kind of the trading account.
You say historically you've made about 30% a year.
Yeah, I'll show you my results in just a sec. So let's see, the setup, so we talked about what expiration to use. I try to make it as simple as possible. I don't look at it and say, oh, do I want to sell 9/15 or 8/28 or what? I just stick to the September. And I want to know where my support level is, and I want to sell my strike that's beyond that move. So if the support level is 100, I want to be selling my put below 100. So if it's at the same level, I don't do the trade. So, and normally the good thing is there's so many potential good trades out there. There are more good trades than you have money. So I just, you probably eliminate 80% of them for one reason or another. And then I look for a P50, probability of profit at 50%. That's a Tastyworks thing. I want it to be 85% or higher. 80 if I really like the stock. Like some stocks I'll trade all the time. Any questions?
The 80 is it's a P50.
P50 is the probability of profit at 50%. And it's just kind of I look at it as just a gauge. if one's a probability of a P50 is 70 and one is 85, then I think this one's a better trade, right? All things being considered, all things being the same.
So Thinkorswim doesn't give you those kind of.
I don't think so. Does anybody use Thinkorswim?
I do, but I don't do this. So.
I mean, generally, if you're selling that 25 delta, that's going to be about a P80. A P50 of an 80% probability.
But Thinkorswim does have the analysis graph, and you can draw a vertical line, and you can slide it around, and when you bring it to the 50% point.
Those make my eyes cross.
Yeah. So it doesn't spit it out automatically, but you can do it through the analysis tool.
Okay.
Okay, cool. And one of the questions in the group was, or in the online was, do we just let the trade expire? You can do that. I don't do that. I close them at the 50% level, or after 21 days, or if it looks like it's running out of gas. So
21 days on a monthly, 30 days?
20 days after I put the trade on. Okay, so executing the trade, that's pretty simple. I always enter them as one trade, one transaction. I don't sell the put and then buy the put. I just do it all at once. And then I use limit orders. I don't do it at market order. I always do it at the midpoint between the bid and the ask. And one thing I would say is, and I'm not really good at this all the time, be patient. So if the trade says you should get $1 and you enter it, and it doesn't immediately ding and fill you at $1, don't change it to 90 cents. Go get a cup of coffee, or go do something. Give it a little time to fill. So that's something that I've learned, kind of like, okay, I'll do 90, and then it drops to 90, and then I'll it's silly. You're giving money away if you do that. So once it's filled at $1, because we've been patient, I set a good to cancel exit at 50%. And what happens is that if I go, if I go to lunch somewhere and it happens to just touch that 50% target and I get executed, that's the best trade in the world, right? You come back and it filled and you got your profit. And if you didn't do that, you wouldn't have been filled. So maybe it got down to the 50% profit for 5 minutes. And then it moved off of that. You lost out. So I always set it and just as a place marker. Leo, do you have a question?
No, I was thinking you would set it at 30% and then move it to 50% after a week.
You could do that. I just set it at 50, but that's probably not a bad idea. And on most platforms, you can set the exit. You can have for today only, good to cancel. And then I know on Tastyworks, you can set it to a specific time. So if you set the trade up on Friday and you said, I want 30% through next Friday, you could set that. Then you just have to reset it again after that. And then the other thing that I do is I set a lot of alerts on my chart. So if a stock, and I don't just do it at the get out level. If it starts to get close to the get out level, I'm getting alerts. So if you guys don't do alerts, I highly recommend using alerts. And someone said, well, how often do I set them for 1 every minute? So it beeps every minute so that it just bugs the crap out of me until I do something. But what you want is you want the alerts to get your attention, right? So that's the purpose there.
Ryan,
Yes.
if you set the exit at 50% of the credit received and you go to lunch and the trade goes against you, how do you protect yourself if
Yeah,
it goes
that's a
the
good
other
question.
direction?
Great question. So the question was, if you set your exit at 50% and the trade moves against you, how do you? Remember, we're selling trades that are out 45 days out. and we're setting alerts on the chart. So if the stock moves against you, you're going to get alerts.
Okay.
So, but at least on Tastyworks, you can't set a stop loss as a limit. You can set a market order, which will give you a terrible fill.
Thinkorswim you can, and you can do one
Could
cancel
you
the
both?
other.
Okay, so you can do that on
Other orders.
yeah. So you could on Thinkorswim, you could set it up as a bracket order. You can't do that on Tastyworks, but I use the alerts, and so I'll know, when the stock is moving against me. If it's moved below that exit level, then I'm going to be out of the trade.
I'm gonna make a suggestion here, Brian.
Sure.
Depending on what platform you're using, whether it's Tasty, Thinkorswim, Trader, or, whatever it is, find out if you can use one cancel the other orders. And you can always call the trade desk and say, help me put in my first one cancel the other order. Example, you buy something at 100, you want to get out at 120, but you want to get out if it goes to 80. You have a way of putting the order in to get out at 120, and if it goes down to 80, it's stopped out, and the other order is canceled automatically. So I'd strongly recommend checking with your platform and learning how to do that, because you can put them both in at the same time or as one order, and not worry about going to lunch.
Yeah.
Thinkorswim will do that, but
Okay.
like you said, it's helpful to get their tech guys to show you how to.
Yeah, and there's a website, if you, in the Thinkorswim, because I've got it bookmarked here, how to enter OCO orders.
Yeah.
So,
just for the people online, the question, Dennis made a great point of saying that whatever platform you're using, see if you can set OCO orders, which will take you out either for a profit or a loss based on preset levels. And that is a great point. So if your platform lets you do that, then I'd set it up both ways. But I'll show you in a minute how we're gonna manage these even differently.
Does the Thinkorswim have the alerts
Yes.
feature?
Yes.
Okay. Yeah, almost even TradingView has alerts, and you can set up your alerts, get them on your phone, get an email, just have it beep like crazy until you do something. So here's my twist on credit spreads. So I sell 45 days out for this particular strategy. I will sell between the 20 and the 25 delta. And then I, again, establish my get out level. That's the level that if it closes below that level, then I'm out of the trade. So, and I say closes. So if it moves below that level and moves back up, I don't get out. So it has to actually be a close on a daily basis below that level. And then I review the charts at least daily, probably 3 times a day, just to see how the stock is moving and is the pattern still holding. And then I will either exit the trade at the 50% credit capture, or if it closes below that level, or if it looks like the stock is either done a bearish reversal or it's just gone sideways. You know how the stock will go up and then it'll just trot sideways? If it's doing that for any length of time, I just get out of the trade. And then I will do it after 21 days. So any questions about that? It's not really earth-shattering, just wanted to share. Okay, any questions? Lee?
Excuse me. After 21 days, if you sold a put spread and the stock is on a trajectory that's going straight north, if you can squeeze more out of it, will you hold on to it, or will you still?
Yeah, probably.
Yeah.
But I can tell you, I rarely hold them longer than 21 days.
rules are made to be broken.
Yeah. If the you know what, I was on vacation for like 2 weeks, and I said, I rarely looked at my stuff. I looked at my spreadsheet because that told me where my stuff was going. So I didn't even have to look at the chart. So when I got back, some of the stuff was like, I got 80% of the credit or 60% of the credit. But that's pretty unusual.
Yeah, it was a good market while you were gone too.
It was a good market, yeah. So,
But-
and then so the day I got back, I'm like closing trades like crazy, and people in the chat room that I was in were saying like, "Wow, like you got paid to be on vacation," which was pretty cool. Of course, I could have been down, on all those trades, but I did.
The wife kept you from looking at it, I think.
Yeah. So this is the tracker that I use. It's not fancy at all. So the first line is just when did I put the trade on? And then I calculate my time stop. That's just 21 days after the entry date. And then I put down where what the stock price was when I put the trade on. So, and then I use Google Finance to just give me a live feed of the price. So that's the current price thing. I don't have to go back in and look it up. There's a little bit of a delay, but it's pretty close.
Is this an Excel?
It's a Google Sheets.
A Google sheet?
Yeah. And so then that's the current price. And then I have my exit level. So that's that get out level. That's like if it drops below that level, I'm closing the trade. So you can see I can look pretty quickly at the current price and the exit level and know, am I in trouble or not, right? And the other thing is, if I bought the stock at 100 and it's now 120, I want to be looking at the chart to see, do I just take my profits? And then I'll put, what's my strikes, short strike, long strike. Again, they're all put, for some reason, I've just kind of moved to just doing put spreads for the credit spread. What's my credit? What's my risk? My thesis, which will be bullish because they're all put spread. And then when I exit the trade, what was the price per contract? How long was I in the trade? And how much did I make per contract?
That list has a really high correlation. Do you do anything about that typically?
If I try not to enter the same types of trades get, you know what I mean? So if like early on, CRM, a lot of tech stuff, but I try to look for, not be all tech or all healthcare or whatever. Any questions about, and I did make a mistake Friday. Must have been ready for the weekend. I did an Apple trade and it has earnings, so I need to get out of that before earnings. Or plan on staying up all night to see how it moves. Yeah, I'll talk about my results on the next slide. So this is, I started this in May with these new rules. So here's my actual results on the trade. So in May, I had a great month. I only closed 5 trades in May. So it was about a 6.85% return on risk. June was 3.8. July, I still have one more day to bump that number up a little bit, but it's like 2.06. So I closed a bunch of trades right before the Fed meeting just to not have as much bullish positions open. So my win rate is about 70%, which isn't great. I mean, you would think it'd be more like 80%, but my cumulative from May through July is about a 7% return on capital, which isn't bad. It's just, I think that's like a 30-something% rate of return. So any questions?
That doesn't include commissions?
It does not include commissions. That would make it really complicated.
Oh, yeah.
So that is the, it's a pretty good strategy. It tends to enable me to not have to sit in front of the computer and track these guys all day long by using, the exit levels and things like that. So anyway, any other questions? Has this been helpful in terms of the credit spreads?
Always reinforcement.
Any other questions anybody has? I know we've gone a little bit over our hour, but
It seems like this is a bull market strategy to me.
well, I mean, you could just sell call spreads in a bear market. So it's, I've just elected in this particular strategy to sell put spreads. But if you were in a bear market, you could, just kind of flip everything backwards. You're going to be looking for bear stocks and then you're going to be looking for resistance levels. You're going to want to sell above resistance levels. I think there's easier ways to make money in bearish markets than selling call spreads.
Would you use the same implied volatility?
I would, yeah. Now, in a bearish market, implied volatility is going to be higher.
Well, that's what I'm asking.
Yeah, so, you might say instead of 25 minimum, maybe it might be 35 minimum. Whatever kind of the going, average is you're looking for. I still wouldn't sell Procter & Gamble in a bearish market just because the implied volatility doesn't pay you for your risk.
And a few others.
And I still wouldn't trade strong fundamentals companies in a bearish market. When I look for bearish trades, I look for the worst stocks I can find. That have options. I don't even know which ones I would pick, but Spotify, those kind of companies that Teladoc, those kind of companies are the ones that I would look for in a bear market because they're going to do worse than the stronger companies, even in a bear market.
I'll give you a list. Everything I buy, you should short.
All right. Send us our list, your list, Lee.
So that's it. Then Lee said his method is whatever he's going long, go short. So I don't buy that for a minute, but and I'm sorry about the people couldn't hear your guys' great questions. So, and I think that's just because they're going through this microphone. So I apologize about that. It has been recorded, so I'll get the recording out as soon as possible. I'll probably take the rest of the day off, so it probably won't be today. So I'm going to stop the recording. Thanks, everybody. I'll see y'all soon.